So you have the initial exemption of 4 lakhs, which is a great thing. 4 to 8 at 5%, 10%, 12%, 16, and goes on to 30. That's what one is trying to achieve here. So let us see what is the effect of this. No change in the old regime. In the new regime, along with this comes the other major change, the rebate. If you have to pay tax, whatever is the tax you have to pay, and now up to 12 lakhs, earlier it was up to 7 lakhs, that tax is given back to you as a rebate. There are some controversies about it. I'll come back to it in a minute. But broadly, this is what it says, that tax is available back to you as a rebate. So you don't really pay it. So then up to 12 lakhs, you don't really have to pay tax. It's a complicated way of doing things. Instead of saying that up to 12 lakhs, there is no tax, or that the initial threshold is not 4 but 12, you give a threshold, you give rates, and then you say, however, whatever tax you have to pay is back to you as a rebate, and therefore the net result is 0. But for some reason, the government has chosen to do this complex working. One would have thought it would make sense if it was going to make a difference between what government shares with the states and what the central government retains. But that is true only of the surcharge and the cess, which they don't share. The tax is shared. So therefore, it makes no difference whether you charge the tax and then give a rebate or you don't charge the tax. You come to the same net result. But maybe it is just that somebody feels he must have some very elaborate formula, otherwise life will be too easy for people. And therefore, you have this elaborate formula there. The rest of the things we have discussed. So this is the effect of the new rates which are coming in. We are comparing them with the existing regime. The new regime, we are not now talking at all of the old regime of tax. As I said, you can opt for that, but forgetting that for a moment, we are now talking about the default regime, the BAC regime. If you are in the default regime, what is the tax you are paying now and what is the tax you will pay from next year? That is what one is saying. In the default regime, at 12 lakhs today, one would pay 83,200. So at 12 lakhs, one would pay 83,200. Whereas under the new regime, now at 12 lakhs, one will pay 0 because of the rebate. The effective tax rate will come to 0%, against 6.9%. And to compare it with, there are various slabs, 20 at 24 lakhs and so on. The important thing is, at 2 crores, you come to the highest surcharge rate. And because of that, the effective tax rate becomes relevant there. The benefit one gets is 1,43,000 compared to what one would have paid in the current year. That's a huge benefit. And the number of taxpayers in excess of 2 crores may be significant. One doesn't know. Going by whatever reported statistics, one is only aware of taxpayers over 1 crore, not over 2 crores. But over 1 crore, you have 3.5 lakh taxpayers. And therefore, assuming over 2 crores, you have about 3 lakh taxpayers. Those 3 lakh taxpayers will get this benefit because of the lower slab rates on the initial slabs. After 24 lakhs, the rate is 30%. Earlier, it was also 30%, but it was after 15 lakhs. That's the only difference. The rate after that, both are on par. You are now paying 30. So that's the position. The other point which is to be noted and which we have also shown in a graph a little later is this, that the tax saving initially from say 8 lakhs income to 12 lakhs income goes up from 31,000 to 83,000. Then it drops to 26,000. and then again starts climbing up. Now, why is that? Why does the tax saving drop and then again climb up? That is something which one has to hello. That is because the moment you cross 12 lakhs in terms of income, there is a marginal relief provision which keeps reducing the rebate to which you are entitled. The tax at 12 lakhs is 60,000. That rebate is reduced consistently by the amount of your income in excess of 12 lakhs. So, because the rebate is reduced, the benefit is reduced. It comes back to more or less the same level as 12 lakhs at 19 lakhs, because then you get the benefit of the lower slab rates initially, and the fact that as compared to the existing regime, at 19 lakhs, you are at a much lower slab rate, 15% as opposed to 20%. So because of that slab rate differences, you start making up, you make up at about 19 lakhs, but you stop at 1,43,000. So now comparing it with the old regime as opposed to the existing new regime, what is the, say that we are dealing now with salaried employees as an example, because it makes easier to understand it for them. Say somebody has a cost to company of 1275, so company is paying this amount to him. Now, assuming he wants to opt for the old regime, he doesn't want to take the benefit of the new regime. What does he have to do? He must find deductions of 7,25,000. If he can find those deductions, he will then effectively pay the same tax which he would pay under the new regime, which is at that level nil, and so on. So, by claiming deductions of up to 8 lakhs, then for an income up to 5 crores, you could pay the same tax under the new regime as you were paying under the old regime. So it's up to the assessee. Now, why would an assessee choose the old regime? He might have deductions under HRA, he might have deductions under ATC, ATD, ATCCD1, and so on. Or he likes to give donations, ATG, ATGGC, which is political donations. Point is, if he wants to claim these deductions, he can only claim them under the old regime. He cannot claim them under the new regime. So the assessee has no choice but to go back to the old regime to enjoy these deductions. And his deductions may be more than the break-even deduction of 725 or 8 lakhs. In that case, he will pay lower tax. He will save. So that is why assessees would go to the old regime, because they can claim a higher deduction. Those who don't want to claim that higher deduction, either because they don't have HRA or they don't want to do the compulsory savings under ATC and so on, in that case, they will go to the new regime and effectively save the same amount of tax without having to claim HRA, without having to go through complicated savings routes. So both options are still available to an assessee, and up to 5 crores, effectively the rates can be similar. Once one crosses 5 crores, and that you are now talking about maybe 20, 30,000 assessees, for them, you cannot go to the old regime. The surcharge at that level is so steep that the deductions which they would have to claim would be so large that by and large it would not work out. And therefore, instead of claiming deductions, they would opt for the new regime and pay lower tax. But up to 5 crores, each assessee will do his own working, depending on what deductions he can claim, whether he should go back to the old regime or he should stay under the new regime. Now, for example, to claim those deductions, take HRA. Take a simple case of somebody having a salary of 30 lakhs and he pays a rent of 12 lakhs and receives HRA of 12 lakhs. So effectively cost to company is 42 lakhs. His real income is 42, but out of that 12 lakhs is HRA and 30 is salary. If you go through the calculations, you will find that he would be entitled to a deduction of 9 lakhs out of that HRA of 12 lakhs. So instead of 42, he will pay tax on 33 because he is entitled to a deduction of 9 lakhs. And he has therefore achieved that break-even deduction of 8 lakhs. In fact, he has crossed it. He would effectively pay lower tax. If he also has other deductions under ATC, ATD, etc., he would pay lower tax. Such an assessee will therefore go to the old regime. For high income assessees, also the old regime may make sense. If one, basically there are two major deductions they can look at. One is HRA and the other is NPS. We'll come to that. As far as HRA is concerned, the salary, let's say we have 5 crores and we divide it between 3.25 crores as salary and 1.75 crores as HRA. In that case, because of the HRA component and the rent which he is paying, he would be entitled to, in fact, a deduction of 52 lakhs saving compared to the tax under the new regime. So it clearly makes sense for him to shift. But this is at a high cost. The high cost is paying an actual rent of 1.75 crores. So it's not coming free. But if he is actually paying that rent, and if he is earning 5 crores, maybe his lifestyle permits him to pay this rent and enjoy that property. So if he is doing that, he is able to save tax by going back to the old regime and claiming HRA, getting his employer to break up his salary in this manner. The anomaly which we have already mentioned is that moment you cross 12 lakhs under the new regime, the rebate gets reduced. It gets reduced by making you pay whatever you earn over and above 12 lakhs as tax. So if you earn 12 lakhs 10,000, you have to pay 10,000 as tax to reduce the rebate by reducing the rebate correspondingly. Net result is if your employer gives you a 5% increment at 12 lakhs and makes it 1260, that 60,000 will go to the government. It does not belong to you. It will go as tax because up to 1270, whatever you get extra will all go away in tax. It's only after 1275 that the increments will belong to you. Till then, they don't belong to you. So this is a major anomaly in a sense. There is marginal relief, but the marginal relief is 100% of the excess over 12 lakhs. If they had, for example, given the marginal relief at say 50% of the excess over 12 lakhs, at least some part of the increment will remain with the employee. Some part will go to the government. Both will get some, will share in that, and the employee will have a reason to seek that increment. Otherwise, employees will tell employers between 12 and 1275, don't give me an increment. There is no point in your giving me an increment, which I have to pay to the government. Now, is there a way out for the employee in this type of situation? The possible way out is NPS. NPS is the way in which the employee could reduce his taxable income. Under the new regime, if his employer contributes to NPS, the employer can contribute up to 14% of his salary. One would work backward to find out how much salary, how much NPS. But based on that, he can, in fact, by getting his employer to make an NPS contribution of only 25,000 at 13 lakhs, save tax of 38,000. So this is the play which one can do with reference to the way in which the rebate is structured and NPS deduction is structured. Under the old regime, one can claim a 10% deduction for NPS contributions. And that is, besides HRA, is the other major deduction which employees can use to bring their tax down even under the old regime. These are just various rates. Now, what is the alternate? As I said, if government really wanted to simplify, all they had to do was to say up to 12 lakhs, the tax rate is nil. Instead of saying up to 4 lakhs, it is nil. And then there are slabs and all. Up to 12, it is nil. And then have graded slabs, much smaller slabs, only 2 lakh slabs, 12 to 14, 10%, 14 to 16, 20%, and above 16, 30%. But the net result would be at 24 lakhs, which is the current level at which the 30% slab kicks in. Effectively, the same tax would be paid under this scheme as it would be paid under the proposed new regime. So government would get the same tax. There's no real difference. More or less, the tax will be made up. And yet, the regime is simpler. You don't have to calculate rebate and all that. You just have to look at your income, look at the slab, and pay the tax depending on where you are placed. Coming to the controversies on the rebate, of which we mentioned a minute back, as I said, there are some controversies which I will come to. The key controversy is this rebate to be calculated on the income which is liable to slab rates or on the total income, whether liable to slab rates or special rates like capital gains income? So if the employee also has capital gains come salary, then will he get rebate even in respect of the tax which he has to pay on capital gains? And the government's view is no. And they have made it very clear. The finance minister made it very clear in the speech. They have made it clear in the explanatory memorandum. They have made it very clear in the FAQs. They are repeating it that the rebate is only meant for income which is chargeable at slab rates. The rebate is not meant for capital gains. So that is the intention. Whether it is borne out by the language is another matter. The intention is clear. No rebate for income taxable at special rates. I'm sure there is simpler language which can be used to achieve it, because currently the language does not seem to bear that out. Under the existing 87A, as it is today, the fact that this is not borne out to an extent was accepted by the Bombay High Court in a public interest litigation, where the Chamber of Tax Consultants requested the court to direct CBDT to at least permit assessors to file a return claiming the rebate. Allowing the rebate, not allowing the rebate is up to CBDT. But you can't have a position where you can't even claim the rebate because you believe that the language of the section permits you to claim the rebate. And the Bombay High Court has accepted that position, and they told the CBDT to modify the utility. The utility is modified. One can claim the rebate. Will the rebate actually be allowed? That depends on CPC. It may not be allowed. The 143(1) orders may still reject that rebate claim and charge tax. Then it is up to the assessee whether he wants to fight it out, claim that rebate based on the interpretation of that section or not. Or forget it because the amounts are not that large. And you are talking about assessees with an income of 12 lakhs and 13 lakhs who don't really have the wherewithal to fight any litigation with the government. So that is one. What they have now tried to do is they have introduced a proviso to say that we are making it clear that it is not available on income chargeable to special rate. But even that proviso does not say so in so many words. And therefore, even then, the proviso does not bear out the intent of the government. One advantage of what the government is saying, if you go by the government's view, then a rebate can be claimed even if your income is in excess of 12 lakhs. Let us say you have 11 lakhs of salary income and 3 lakhs of capital gains income. Your income is 14 lakhs. One view is you have crossed the 12 lakhs threshold, you are not entitled to any rebate. And the other view is no, my income chargeable at slab rates is only 11 lakhs. Forget the capital gain of 3 lakhs. That is fully taxable. I will pay tax on that. But on the 11 lakhs, I can claim the rebate. So that is one view. Now, this view would be aligned with the government's view. Government is willing to give you this relief and give you the relief on that 11 lakhs. On the other hand, if one takes the view that no, rebate is linked to total income because the section everywhere refers to total income, even the proviso refers to total income and does not distinguish between income chargeable at slab rates and other income, except to say that the rebate is linked to the slab rate tax. In that case, for example, if an assessee has 10 lakhs income of say 8 lakhs of salary and 2 lakhs of capital gains, he would claim the rebate on the entire 10 lakhs. He would only pay on the capital gains the tax which is in excess of the rebate rate. Now, at that rate, his slab rate is 10% between over 8 lakhs. The capital gains rate is 12.5. He would pay the difference of 2.5. But other than that, he would claim full rebate include on 8 lakhs of salary and on the 2 lakhs of capital gain. So both views prevail. This is the view of the assessee. As I said, the Bombay High Court has only said that there seems to be some basis to it. That is why they have directed CBDT to give this utility, but they have not given an answer as to which of the two views is correct. They have said that will be decided in appeals and in the normal course. That is not for us to decide at this stage. Now coming to, so this is as far as rates of tax go, the major change of this budget is the rates of tax. The fact that this change of rates of tax and the rebate will put 1 lakh crores in the hands of assessees. That is the real major change. That is the real theme behind the budget. As I said, all the other amendments are minor, not of the same importance, and nowhere of significance. So we have understood that those changes in rates are a little complicated to actually apply. There is this whole issue of rebate and how the rebate is to be calculated and allowed and all. But if you give up everything and just go by the government's view, then it is simple. You calculate, claim, and finish it. That is what the utility provides for. If you believe you are entitled to more, there is, as I said, arguable case for more. Now coming to the other amendments, which are not of that same significance. The first amendment relates to house property income. For even today, if you have a house property which is self-occupied, not let out, you are staying in it. You don't have to pay tax on that house. If you have two such houses, you still don't have to pay tax on the two houses if you are living in both of them. Now, when I say living in both of them, it would mean that maybe 10 months in a year you live in your house in Bombay, and 2 months in a year you live in your house in Delhi for whatever reasons. You are still living in both of them. And because you are living in both of them, you are entitled to claim the exemption. You would not pay tax on house property income. If you have three houses, the third house, you will pay tax even though you earn nothing. Because there is a deemed income of that third house. You could have earned by letting it out. You have not let it out. You will have to pay on that deemed income. So that is the current position up to two houses. There was a condition imposed in the Act for claiming this deduction for these two houses. The condition was you stay in them. That's a simple condition. Or if you cannot stay in them, you justify why you cannot stay in them. The reason why you cannot stay in them should be that your job is at a different location, or your work, your career is at a different location. And that is why you cannot stay in the house. So what you are saying is, my house is in Pune, I am living in Mumbai. Naturally, I can't stay in my house in Pune, but I should still get the exemption. Today, you would get the exemption. Now onwards, government has said, we don't bother about why you are not staying in Pune. Take your two houses. We are not going to ask you whether you are staying in them or not staying in them. And if you are not staying in them, why are you not staying in them? Both your houses are exempt. So that is the only change, that you don't have to give reasons. Nothing else really changes. As I said, even today, it really didn't matter. You could always say, I'm living in both of them. And if you say that I'm living in both of them, that was reason enough to claim that exemption. There is one more condition, even today, which continues for being able to claim this exemption. The first is it should not be let out. Goes without saying. You're saying self-occupied. You are saying you are using it for yourself. And even if you are not staying, you are keeping it vacant for reasons beyond your control. So not being let out goes without saying. The second condition is no other benefit must be derived from that house. That condition continues. But what do you mean by no other benefit is derived? It's a very difficult phrase to construe. Going by the current FAQs, one thing seems to be clear. Allowing members of your family to stay there is not a benefit. So the benefit must mean perhaps a monetary benefit, which is as good as letting it out. Or must mean, say, running a business from them, running a classes from that place. That would be a benefit which you are deriving from that house. And if you derive such a benefit from that house, then you can't claim the self-occupied property exemption. So that is about that condition continues. In practice, one has never seen this condition really impose any major impediment to any assessee. So it's just for the sake of mentioning that one needs to clarify. But then even the other condition never created an impediment. So why has the finance bill gone to the extent of removing those conditions? One doesn't know. You are being given a benefit of some condition being taken away, which condition in any case was never being enforced. But that's the position. Then comes the next clarification, ULIPs. In 21, government felt that people are taking advantage of an exemption for unit-linked insurance policies, under which you contribute to the policy by way of premium. Your premium is invested. That investment may give you a return, and that return you will get back as redemption of the policy on the maturity date. So you take that income back. Effectively, you are earning a yield by investing your money, but you are investing your money not directly. You are investing your money by paying a premium to the insurance company, and the insurance company is investing it for you, and then they are giving you a yield. That was the position. That redemption which you got back was, and even today, is tax-free. Section 1010D gives that exemption. So the idea is people are encouraged to take life insurance. In the process, if they make money, that money which they make is exempt. That's one more reason why they would perhaps go and take life insurance instead of directly investing. Because if you directly invest it, the interest or the dividend would be taxable. Whereas if you get it via the insurance company, it will not be taxable. Then in 21, they said, no, but this is not correct. We are giving this exemption. We want to give this exemption, but we only want to give it to small assessees. The high net worth individuals are taking advantage of this exemption, by putting in huge premiums into insurance companies. That we cannot permit. So we will now onwards put a condition that this exemption is available only if the premium is less than 2.5 lakhs. If it is more than 2.5 lakhs, this exemption is not available. Thereafter, they brought in a similar condition even for normal life insurance, not just ULIP, where the condition was 5 crores, 5 lakhs. So 5 lakhs premium or 2.5 lakhs premium. These two conditions, if you pay more premiums than that, you don't get exemption. Then whenever you get your money back from the insurance company, the income which you get is taxable. Now, to say this, the amendment had to use the reference, so it referred to those provisos which dealt with the 2.5 lakhs limit and dealt with them and said that in respect of these cases, the exemption is removed. When it came to life insurance in 23, the exemption was removed for the cases over 5 lakhs. But a further additional problem was created. That income was taxable as income from other sources, not as capital gains. So people taking life insurance suffered twice. One, they were not entitled to the exemption if they paid more than 5 lakhs. And not only that, the income was then taxable as other source income, not as capital gains. The result was this was fine. This was a specific provision for life insurance. The question which then arose was, if I have a ULIP policy and the income is taxable because I'm paying more than 2.5 lakhs or for any other reason, then is it taxable as other sources? Is it taxable as capital gain? Which of the two provisions will apply? Capital gains pay lesser tax. If it is long term today, they pay only 12.5%, whereas other sources would pay the normal rates of tax. So naturally, people would prefer capital gains. What is now being made clear is ULIPs are capital assets. Because after all, you are investing through the insurance company into the ULIPs. They are capital assets, and therefore whatever you earn is a capital gain. That part is okay. So this is a clarificatory amendment which takes care of the possibility of somebody, some officer telling you that I will charge you other sources. On life insurance, however, he will charge you other sources. The only question which one needs to examine is this fair? For ULIPs, which is one mode of insurance with investment, the income is taxable as capital gain, lower rate. For life insurance, which is another mode of investment, because life insurance premium is also invested by the insurance company. It's not as if they keep it with themselves. So it's another mode of investment. When you get it back, it's taxable as other sources. Why should this higher tax be there on life insurance? Maybe if one government accepts it for ULIPs, hopefully in a year or two, they will accept it for life insurance also. The other change is on NPS for individuals. It's a new scheme which was introduced in September 24. Under that scheme, one can put in a contribution into the pension fund of up to 50,000. And during the minority of your child, the scheme allows you to put in the contribution in the name of the child, and that to a minor child. During his minority, if some illness, etc., happens, you can withdraw up to 25%. Otherwise, the money accumulates. And when he becomes a major, either he converts it into a regular pension account or he buys an annuity for 80% of the amount, and 20% of the amount is allowed to be withdrawn. That 20% comes back at that day. The scheme perhaps allows you to withdraw the whole if the amount involved is only less than 2.5 lakhs. Otherwise, one has to go through this 20/80 route. That withdrawal of that 20%. So the 25% which you withdraw for necessity is exempt. even though the deduction was given as a deduction to you. So you saved tax by paying the premium, and you didn't pay tax when you got it back. That's for the first 25%. But the 20% which you get on maturity, that is according to the explanatory memorandum taxable. I'm saying explanatory memorandum. There is no specific section, subsection, which makes it taxable. The existing section continues. 80cc D3 continues to say that. But 80cc D3 says that the assessee will be taxable. But the withdrawal may be by the child when he becomes a major. It is not by the parent. So the money has gone to the child. Now, is that check taxable under HECC D3? Will that be taxable in the hands of the parent? To my reading of that section, it should not be taxable. Will it be taxable in the hands of the child? No, because he never claimed a deduction in the first place. It was claimed by his parent. So why should he be taxable? So my child should not be taxable. The parent should not be taxable because he doesn't get the money, and the section taxes him if he gets the money. So in that case, though the explanatory memorandum says it is taxable, perhaps that 20% may not be taxable. It's a gray area. One will have to see, because you are clearly again going against the intent of government, but not against the language of government. The language doesn't bring out their intent. These are the various, just for information, the various rates which therefore today prevail. LTCG effective tax rates comes to 14% and so on. The highest rate is for an individual under the old rate at 42%, under the new regime at 39%. And for companies, you now have so many different rates: 17, 25, 29, 34 or 35, and foreign companies at 38. You have to see where you are and pay. But just to point out that there is still a plethora of rates applicable. Even though the new regime makes default rates, BAC, and so on, the plethora of rates is not really going away. Coming back to the changes, the other major change for individuals is a permission to do updated returns. This, according to the finance minister and therefore according to the government, is something where they are trusting assessees, providing for transparency, and saying that as part of our mutual give and take with assessees, as part of trusting them, as part of honoring them, so to say, accepting what they do, we will not assess them on a higher income than what they have returned. We will not charge them interest. We will not charge them penalty, so long as assessees voluntarily come and tell us, I have forgotten to include some income. I am now including it, and I'm willing to pay the tax on it. So that is the position. I mean, it's great to say that you trust assessees, and what you are asking them is, if you have made mistakes, please come and tell us that you have made mistakes. What you have forgotten, please pay the tax. If it was simple as that, great. Then what government is saying is true. They are really trusting assessees. It is transparent. It's not as simple as that. What government is saying is, if you want to turn up and tell me that you have made a mistake or make a clean breast and therefore pay the tax which you had forgotten to pay, please pay it. But first pay, I won't call it a penalty, but an additional tax. It's just the name which is changed. Pay extra 25, 50, 60, 70%. So pay an additional tax. Then pay interest, because you should have paid it in that year. You are paying it now. So pay interest. So tax plus interest, and the additional tax is on tax plus interest. So pay this whole thing. And if you are willing to pay this, then I will accept that you are being honest. And I will not charge you penalty. That is effectively this provision. This provision today allows you to file updated returns for 24 months. Now the amendment is you can file them for 48 months. You will see that there would be no reason why you would normally do it. Just see the consequences at the 48-month level. If you want to come up and say, this income I had not originally paid, I now want to pay. Tax plus interest plus this additional tax as percentage of income in a 24 to 36 month case would be as much as 97% if you had not originally filed returns, but even otherwise 76. And in 36 to 48 months, it's as much as 116%. So it's more than the income. You have to pay the whole of the income to the government plus 16%. That's what you would have to pay if you had not originally filed a return. What happens if government, let's say you had filed returns and you don't therefore do this, and government assesses you to an extra tax and charges penalty saying you are a dishonest assessee. So there is a penalty charged. Now, if that penalty is charged for underreporting, which is considered to be bona fide non-inclusions, genuine mistakes or non-inclusions which are justified because you believed it was not taxable, the officer believed it was taxable. Those type of cases, they are called underreporting. Then you pay a penalty of only 50% of tax. And that penalty is only on tax, not on the interest component. You don't pay interest because you have included it in the return in the first place. So interest is payable, but you don't pay additional tax on interest. So it's a much, much lower threshold of penalty. So why would you go through this whole route? You would go through it if it is a case of misreporting. If it is a case of misreporting, the penalty is 200%. And there is a possibility of prosecution. Therefore, you will go through this route to avoid being penalized and prosecuted. So only assessees who have deliberately evaded tax are now free to take this route and pay up a tax with interest and additional tax, but get out of penalty and prosecution. Other assessees will not come to this route. And that seems to be proved by the fact that though this scheme has been there for more than 2 years now, almost 3 years, all that government has got is 90 lakh returns. The returns seem to be large because if you compare it to the fact that there are only about 8 crore assessees, 90 lakhs is a large number. But out of 8 crores, only 3 crores are paying tax. So 90 lakhs is even larger number if you look at it that way. But the tax collected from those 90% is only 8,500 crores. Now your normal tax collection is 16 lakh crores in a year. So 8,500 is not even 0.5% or just about 0.5% of the total tax. So it's an insignificant amount for which they have collected. The amount is not large. Number of assessees are large. So people with small mistakes of 50 and 100 and 500 and 1,000 and 2,000 rupees are willing to settle it this way. Otherwise, and this happens when you get a 143(1), or if you get an idea, indication that they are likely to find something, you therefore pay it up voluntarily. But otherwise, no. So this change from 2 to 4 years is not going to be of significance. The next, again, major change in a sense is that of one more presumptive tax, 44 BBD. You have a variety of presumptive taxes for shipping companies and for construction companies in oil and gas sector, exploration, and so on and so forth. So variety of presumptive taxes are there for non-residents. One more presumptive tax is being added for non-residents. This is for non-residents providing services or technology into electronic manufacturing facilities. So, and the idea is that we are going in for semiconductors. India is going to be a major player in electronic manufacturing. And therefore, naturally, we will need consultants. We will need people who have the technology, who will give us the technology. And we will need people who know how to use the technology. So they'll come and give us the services to set up and operate these manufacturing facilities. So we will need both. And because we will need these services, let's give them a simple presumptive tax so that the people giving this service don't have the hassle of, because everybody is afraid of India and the India's tax system, especially non-residents. That's one reason why he may say, I don't want to give service to an Indian, not because your fee is not correct, not because I am not able to give this service. I know it. I would like to do business with you. But if that means I have to file returns in India, I have to meet your tax officers or deal with them, I don't want to. I would rather give my service somewhere else. I will go to another country and do my business. I will not come to India. That possibility is there in the minds of non residents. To get over that, you are giving them the presumptive taxes, whereby the non residents would say, all right, I don't have to go through a major hassle. The rate of tax and the rate of profit is fixed in advance. And therefore, I don't have to worry. That's what it is doing. So, the current provision for any such royalty or FTS is covered in Section 44DA. If they had not given this presumptive tax, a person giving this service would be covered by Section 44DA. Under 44DA, he is allowed to claim all his expenses. He must maintain his accounts, claim his expenses, work out his profit, and on his profit, because he is a foreign company, pay 38.22% tax, including surcharge and cess. So that is the simple position. He is, of course, covered by MAT, but that may not matter because by and large, MAT and taxable income will be similar in such cases. If he is now entitled to this presumptive tax, what is the main benefit he is getting? Let us say he's earning 25%, because let's assume that that's a reasonable profit for a service provider. Then today he would pay this 10% tax under 44DA. But he would have to prove that he has earned 25. And if he is earning 50, he will pay 20% tax. He'll pay double. Whereas now, without having to prove all that, it will be deemed that he has earned 25%, and therefore his tax will come down to 9.56%. That is therefore the main benefit of this presumptive tax. Both sections exist in the Act. So because both sections exist, which one will apply? The answer is BBD will now apply, because that is specific for people giving services in electronics. People giving other services will continue to be governed by 44DA. One negative of BBD is the deemed profit is minimum 25%. So if you have actually earned only 10%, you would have gone under DA and paid only 4% as tax. You can't do that now because you have earned 10%, but the deeming fiction is 25%. So you must pay 10% tax. Effectively, your whole profit will go away in tax. That is the position of the deeming fiction. Some of the deeming fictions, the presumptions, permit you to claim lower profits. That permission is still not there in 44 BBD. Can you still claim that lower profit and pay a lower tax? And the answer I would say is yes, if you are coming in from a treaty country. And today, almost all service providers come in from some treaty country or the other. India has one of the largest network of double tax treaties. So almost any service provider would be coming in from a country which is covered by a treaty. If it is covered by the treaty, then you can say, I will not go by your act. I will not look at 44DA. I will not look at 44 BBD. I will look at the treaty. I will look at Article 7 and pay my tax accordingly on my actual profits. Your actual profits will be computed more or less as per 44DA. But if you are coming in from a non-treaty country, you don't have that choice. You will have to pay the tax under BBD. Now, this is all applicable if you are coming to India, setting up shop in India, and giving this service. If you are not coming to India, if you are giving this service from outside India with no permanent establishment in India, then you compare 44 BBD with another section, 115A. Here the benefit is clearly apparent. Under 115A, the rate of tax would effectively be 21.84%. Under BBD, the rate of tax is effectively 9.56. That 21 you can reduce by going to the treaties. This 9.56 you can't reduce by going to treaties because virtually no treaty is lower than this. So, except there are some treaties where you can take advantage, where the view is that FTS, foreign technical services, are not taxable in India at all. But they are very few and far between. Most treaties would charge you a higher rate than 10%. So because you would be paying more than 10, treaties will not help you now. You will now pay this 10%. If you are not coming to India to set up shop in India, if you are giving the service from wherever you are. If you come and set up shop in India, we have discussed the earlier provisions. A major change, in a sense, is that in relation to transfer pricing. What is this change? As I mentioned, most of these changes are tinkering. This is one of those also. What it says is, we now want that we don't want the tax transfer pricing officer to determine the arm's length price every year for repetitive transactions. You have a rental or an interest which you are paying to your foreign company, foreign head office or associate or holding company. Since you are paying them, that transaction is going to happen every year. Determining what is the arm's length price of that rent or that interest is something which today the transfer pricing officer has to do every year if a reference is made to him. That is, if the transaction is crossing those thresholds. And a large number of transactions cross those thresholds. So you have a large number of references. Now it's repetitive work. Of course, in my articleship days, the simple solution when you had repetitive work was a rubber stamp which said as per last year. So you could still do that. The transfer pricing officer could have put that rubber stamp and said as per last year. But instead of putting that rubber stamp, now the Act is saying that whatever he determines will be determined for 3 years, will be valid for 3 years. And he will again look at it in the 4th year. The provision is therefore good. The provision is very difficult to understand. It is stated. How does it actually work? Assessments are made every year. References are made every year. Orders are passed every year. So how will this provision work under which the transfer pricing officer will make that determination once and it will apply for the next 2 years? Then again, in transfer pricing, some facts keep changing. So you have worked out a transactional net margin, and you have worked out that the transactional net margin, the share of profit which India should earn on the materials which it is importing and selling, should be roughly 22% on the sales made in India. That 22% can then be applied in year 1, 2, and 3. But the sales can change. Naturally, you will apply 22 to the sales, whatever they are. But that 22 also can change. So the officer has to be sure that that 22 has not changed. Now, how can it change? It can change because competition comes in. And competition therefore compels you to reduce prices. It can change because competition is reduced and you are able to increase prices. So circumstances keep changing. So this whole business will require, the system is, after you get, so to say, the first year's order, and I'm not sure about that after, because that is not clarified in the Act. It is said the time of filing the option is going to be given in the rules. But assuming that it is after. So after you get the first year's order, you tell the officer or the TPO that please adopt this for the next 2 years. That is what it says. He will then decide whether to accept your offer or not to accept your offer. If he accepts your offer, he will then adopt it for the next 2 years, subject, as I said, to these issues about changes and all that. But how will he adopt it for the next 2 years? So will a reference be made to him and he will answer that reference in the same way in the next 2 years? And there the section is not clear whether the reference will be made or not. It says the reference will not be made. So no reference will be made. It says even if a reference is made, already made, it will be deemed not to have been made. That's good. But if no reference is made, how will he pass an order saying that in second year and third year I am accepting your number? And that order is supposed to be under the same section, which is the order under the reference, subsection 3. So how will he pass that order when there is no reference to him? How will subsection 3 apply? That is not made clear. When you will apply for this is not made clear. What is also not made clear is that once this acceptance comes, the assessing officer will rectify your assessment order for the next 2 years. If I have done this after the first year, I have made this option, then the order and the option may have been accepted before the order for the next year. If that is so, then this should not be a problem. For assessment year 25-26, the time barring period would be 31st March 28. By March 28, sorry, for assessment year 26-27, it would be March 28. The assessing officer has to make up his mind whether to refer it to the TPO or not to refer. If he doesn't refer, he must pass the order. If he refers, he has one more year. The time barring would be March 29. So in all probability, he would do this in March 28. Based on that, the TP order would come by January 29. Assuming the order comes that way, it would be available before the next year's reference is due in March. So the TP order would come, the option would be exercised, and you would know whether the option is accepted or not. So no reference would be made. But then how would a Section 3 order be passed? Cannot be passed. And the assessment order would be passed after that. So where is the need to rectify it? The whole reason and provision for rectification then seems to be meaningless. So the process is very complex. One does not understand. Just as a matter of curiosity, in the Wealth Tax Act, when it was there, you had a schedule, Schedule 3 for valuation. Part G of Schedule 3, in respect of jewelry, had a similar provision saying jewelry valuation of 1 year is valid for a 5-year block for the next 4 years, except to the extent of changes in the rates of gold and silver. So that was simple. You have changes in relation to IFSC. These are IFSC itself is of limited interest because the number of assessees availing that advantage is not as yet very significant. The changes are not material. In relation to insurance policies there, this limit of 2.5 and 5 lakhs and all, which I mentioned, they're only 5 lakhs, not ULIPs, are all being done away with. There you can pay more than 5 lakhs premium and get back money and still be exempt. But this would be applicable on the assumption that the people paying these premiums are non-residents. But even residents can pay this premium, can they? Not very clear. Can it be done through LRS? But certainly they can use their foreign funds if they have them to make these premiums and earn this income, assuming the income is good because the money is invested in India and Indians' returns are good, that higher return will be tax-free. That is all that it says. Ship leasing is now being put on par with aircraft leasing, so nothing major change there. For eligible fund managers, there is a change about the condition that In that fund, the resident investor should not be more than 5%. But what is the change? The condition is not withdrawn. It's not that you can have more investors. And the change is we will test it on twice a year in October and March. And we will then give you 4 months to correct. So if on October 31, when it will be tested, you are not proper, you should come in line by January 31. So what it really means is twice a year on January 31 and on August 31, you must make sure that resident investors are below 5%. Because in October and March, government will test. They will say you are not valid. They will come back and check in January and August. Because you have got 4 months to rectify. Have you rectified? You have rectified. Good. You are eligible for this relief. So in any case, it's going to be tested. All that they are trying to say is we will test it only twice a year. And we are telling you on which date you have to be compliant. In the meantime, you can have 25% resident investment, so long as that resident exits before this date and comes back on the next day. That's permissible. That's the only way one can understand this to be a relaxation. Otherwise, there is no relaxation in this amendment that one can see. And along with that, there is another change. The central government today has a power to waive this condition. That power is taken away. Central government could have waived this condition for IFSC fund managers. That power is taken away. So government will not waive it hereafter. Sovereign wealth funds are very limited. Counterparties in FPI is the same as what offshore banking units were there. A new scheme has come in for them from May 24, so it's being given to them also. Coming to charities, one major change is the situations in which a commissioner can cancel your registration. And the list is exhaustive. It frightens one. Most charities are afraid of that list. It can be cancelled for a variety of reasons. The commissioner may feel that you are not doing charity properly, you are not fulfilling your objects, what you are doing is contrary to your objects, it's contrary to some law. It could be a variety of reasons. Those reasons and those risks remain. One of those reasons was that your original application was incomplete, false, or incorrect. Now, what government is saying is, we have got 3 words there. You could cancel it for incomplete, false, or incorrect. Incomplete could be minor errors, minor default, and that may lead to cancellation. That's not fair. So we are now removing that word incomplete. But the words false and incorrect continue. Now, false, one can understand. If you have deliberately made something false, you should suffer. Incorrect? What is the difference between incomplete and incorrect? A bona fide error? I was set up in 75 by mistake, I wrote 76. It's incorrect. My application is incorrect. Therefore, my registration should be cancelled. Now, the commissioner will give you a hearing before cancelling. But what can he do? Under the hearing, he has only to find out whether the mistake that you wrote 76 in place of 75 is a fact. And that is a fact which he will find out in 1 minute, whether you wrote 76 or you wrote 75. Nothing else has to be found. Once he finds that, the commissioner can do nothing but cancel your registration, because the word is shall, not may.
Yeah. Yeah, Gautam, I think you just got dropped off for a minute.
Yeah, I'm back.
Yeah.
Good.
Yeah.
Okay. Okay. It's working now.
Yeah, it's absolutely working.
Fine. So we were talking about charities.
Yeah.
Coming to significant economic presence, it's a dormant provision today. Until the treaties are amended, this provision has no relevance. Even there, they are giving a concession. The concession seems to be geared on the point that the current exclusion for exports, is for operations. SCP applies to transactions. They are worried that some officer will say that transactions is different from operations, so the exemption for operations will not be allowed for cases of transactions. Therefore, now they are clarifying that even for transactions, you would get the exemption. But as I said, in the section itself is not applicable, not to worry. Alternate investment funds, you are now clarifying that their liquid investments will also be deemed to be capital assets. I mean, temporary investments in liquid funds are capital assets and capital gains will follow. It could give some advantages to some non-resident investors because through the AIF they can gain money on debt instruments. But if under the treaty capital gains are not to be taxed in India, they can avoid paying tax in India. Resident investors can convert trading profits through an AIF from securities into capital gains. It's only arbitrage on the rate of tax, otherwise nothing very much material. The change in relation to carry forward losses for companies. Today, when you do a merger, and if you merge a loss-making company, subject to a variety of conditions about the type of company, manufacturing company, software, type of plant and machinery which you take over, and so on, keeping the plant and machinery constant, capacity achievement, etc. Those losses are allowed as your losses for 8 years. It's a fresh lease of life. Government feels that there is evergreening of these losses. I can't really see how you can do evergreening. After that merger, if you have 8 years to use it and you can't use it, and then you do a merger again after 8 years, technically, yes, you could say it's evergreening. But how many such cases could possibly be there where you actually merge to take advantage of the loss, but you are so poor at it that you can't take advantage for 8 years? Then you now think of doing it once more and keeping that loss alive, and thereby keeping the loss alive forever. But you are applying this to whom? I can understand to private companies who might do this. You are saying they might be doing this. You are saying even when a government company merges into a government company, we will treat it as a possible evergreening, and we will therefore still object to it and say we will not allow this loss beyond 8 years, beyond the first year in which the loss was suffered. Are you saying government companies are also doing evergreening? Are you saying your strategic divestments are evergreening? You are covering all of them also. It can't possibly be. So one doesn't know what is the reason for this amendment, but it is there. The amendment is, it doesn't really hurt. You will get the loss. Only thing is you will not get it for 8 years. Now, what is the problem today? IBC takes 4, 5, 6 years before a sick company's resolution plan is approved. The Act says 240 days and capable of 365 is supposed to be the outer limit. But the reality is 4, 5, 6 years and not 240 or 365 days. And everybody has accepted that reality. So if you merge a sick company under IBC in the 5th year or 6th year, you only have 2 years to make good the loss. And that too only the last 2 years which that company suffered before it became sick. Earlier losses have lapsed. Those would lapse in any case. But you will now also have only 2 years left instead of getting 8 years more for all the losses. So there is also the language of this clause also has, it applies to mergers effected after April 1, 25 and tries to cover mergers before April 25. Does it try to cover? So two problems. There could be mergers in progress where you are planning to merge post April 25. You have planned on the loss, now you can't do it. There could be mergers pre 25 where, say, a company A merged into B, B merged into C, which is what government is objecting to. In that case, effectively, you are hurting the merger which happened 5 years back, and you are applying the law to it today. So you are effectively making a retrospective amendment. But leaving aside all this technicalities, effectively, the loss is allowed to be transferred. The section is not taken away. If you get 2-3 years also, for genuine mergers, there should be no problem, enough to set off the loss and take advantage. And if they are bogus mergers, even then, better still, no problem, because you will make sure that you have profit in 1 year. So if you have traded for loss, if you have paid for it, you are going to make sure of it. So both genuine and bogus mergers will not be impacted. This will only mean additional paperwork. Then TDS and TCS, only thresholds are changed. No real simplifications. 5,000 becomes 10,000, nil becomes 10,000, and so on. Only the numbers are changed. In some cases, aggregate is coming down to annual, and so on. So nothing of which one needs to discuss. The significant reduction is in LBC, investment in securitization trusts, where the rate is really coming down from 25 and 30 to 10. Why? Because now everything is proper, organized, and therefore government is in a position to check who's doing what in these trusts. If that is true, why do you want even 10% TDS? So first, government has to make up its mind. Is TCS, TDS a means of revenue, or is it a means of statistics? If it is revenue, why do you have TDS, TCS in a country which has got advanced tax for revenue? What is the purpose? If it is only for statistics, then number of these provisions can go. The other changes there is, the main change is 206AB and 6, where non-filers of tax return, if you were dealing with him, you had to increase the rate for TDS, TCS. Now you will not have to do that. Those two sections are deleted. And one view of the matter is, if those sections are deleted, it is as if they were never there. So even your past problems are resolved. It's one view of the matter. There is a High Court decision giving that effect, export. Another view may come up from the General Clauses Act. One has to see which of the two views will prevail. But that one view is certainly possible. A High Court has accepted it. The effective date of all these changes is April 25. Why April 25? Your act will be passed, if at all, only in March sometime. When will companies amend? When will they change their processes? When will they change their software? Give some time for a change. And secondly, this means you assume that the president will sign it in March. It's a lot of assumptions to make. Then search the provisions they introduced last year with effect from 1st September 24. They found that they had made some errors in the drafting. Those errors in the drafting are now being corrected. There doesn't seem to be new errors in the drafting. There still remains some lacunas. Those lacunas which were there originally are continuing. All lacunas are not covered. So, for example, if you have income which is reflected in the books, but there is an error in the books and that is rectified. But those books were in respect of a year which ended before the date of search. That rectification, will it become undisclosed income? Will it remain disclosed income? Things like that remain grey. So it is not as if all lacunas are taken care of. But lacunas which were there in last year's amendments are now corrected. On the period of stay, there is an amendment that if any officer of the government, if he receives the service, that's not enough. The principal commissioner should receive. Change of dates for startups and others is not relevant. Business trust, they are now making it clear that their listed securities will also be benefiting from the capital gains rate. But that is all in one chapter. Similar provision is there for discretionary trusts. There it is not made clear. Will discretionary trusts pay maximum marginal rate on their capital gains? Uncertain. The uncertainty is growing because in another case where it was uncertain, you are making it clear by an amendment. You are not making it clear by amendment for discretionary trust. And if an amendment was necessary, that means in the other one it is taxable. So possibility. Safe harbor rules will come in the future. Tonnage tax scheme coming for inland waterways, not of materiality. 115 AD, a mistake of last year, again made good. The FDI in insurance with a limit of coming up from 74 to 100, which again you are now putting a condition, which invests the entire premium in India. The condition looks nice. What does it mean? How many Indian companies have foreign subsidiaries? How many Indian companies have foreign branches? Almost all the big ones are operating both in India and outside India. And Infosys is not operating in India only. It's also operating on 100 countries of the world. Now, if you invest your premium in shares of Infosys, is it in India or is it outside India? All those look-through, see-through provisions will come through as an issue when the government finally makes up the law on this subject. Today, this is only a policy announcement. So thank you. I think this takes us through the key amendments in the finance bill.
Gautam, what a riveting 75 minutes. I loved every bit of it. I'm sure a lot of people joined on YouTube because the webinar here was full. Lots of questions, but Gautam Bhai has a hard stop. So, some questions I'll bring it to. I'll request my colleagues to note down the questions. Some of them we'll see if Gautam Bhai can find the time over the weekend to answer some of them. Gautam Bhai, I can't leave you without asking one question on the new code. I know you're not for it. You said since I interviewed you in 2009, at Bloomberg, where you said there was no need for a DTC, and DTC seemed more progressive than what we are expecting now. So much of drafting errors or drafting lacunas just in the finance bill with very few amendments. 100 IRS officers working, new code. What is your expectation, having read whatever you've read, Gautam Bhai, so far about it, about this revamp, and any worries?
Yeah. And definitely, yes, worries are there. We are talking about a revamp. We are talking major thing which we are saying is everything is being rephrased and is being put in simple language and in lesser words. More than how many of the current words and phrases of the Act have been explained by the Supreme Court? I would assume more than 200-300 have by today been explained by the Supreme Court. So now you know what that word means or what that phrase means. Now you're going to use a different phrase to say the same thing. Does it still remain the same thing? It's always a question mark. The synonyms, if you go to find on the dictionary, you will find at least 50 synonyms for any word. But which of those 50 has the same meaning as the original meaning? Impossible to say. So where will we end up by again going through the Supreme Court with these words and these phrases? Because simplification to my mind is one very simple thing. Reduce the rate of tax, it's simple. Increase the rate of tax, it's tough. Simplification is that. Look at Indian income tax. It is complex. Look at the Income Tax Act of UK. Just try and read those finance acts and try to make sense out of that language. Look at the language in US. You are not able to make sense. You then have to go to a commentary. You have to go to the HMRC commentary, which explains what the act says. The commentary perhaps can tell you what the act says. If you read the original act, you will not be able to understand it. So it's fine. That works. Complex language is not a problem. Complications are not a problem. Simplicity is required in concept, and second, in how it is enforced. If you enforce it in the spirit, it is simple. If you enforce it to harass, it is not simple.
Gautam,
Therefore, I don't see what we will achieve by this.
Yeah, would it be more litigation, Gautam Bhatt? See, I want to quote what the finance minister has said in an interview to Times of India. She said the day after the budget that there are two on the new code and the revamp. She says that there are several issues which are in court where both sides are right. So the anxiety of the taxpayer would be that now with the IRS officers drafting this code, where both sides are right, I think they may weigh on one side.
More likely than not, no question about that. They will possibly weigh on one side like 87A this time. Just see. After all, the courts have said that there are two views possible. The Bombay High Court has said. Government has come back, added a proviso. Even then, they have not been able to make their aspect clear that it will not apply to special rates. It's not clear beyond a doubt. If we litigate on that, government will come back and say, okay, you are unnecessarily harassing, creating litigation. This is we are being put to trouble. So we will now simplify. So what will you simplify? You could do it today also in that 87A.
Yeah. True. Mr. Sanjeev Chaudhary says, thanks a lot for the excellent presentation. And he says, we will have more litigation. I think that means a lot more work for everyone here.
Yes.
And also a lot for us to go over, to mull, to chew, to digest, and to come back with more analysis. But we are all looking forward we are looking forward to that code. I think it should come any time now. She said, finance minister said next week, which is this week. We have a few more days to go in this week, or maybe early next week. But I think we are really, really in for some exciting times in the coming days and weeks. Gautam bhai, we'll get you again at that time. For now, many thanks. Grateful for the wonderful presentation, for the incisive analysis of Finance Bill 2025. We look forward to having you back, Gautam bhai. Thank you, everyone, for a patient audience.
Thank you, Arun.